Okay, so let's take a look at this week's portfolio. We have 94% in U.S. stocks and 6% are outside of the U.S. 100% of the portfolio is in large cap stocks. 47% of those are value, 35% are core, and 17% are growth. So let's go down to the sector split up. It looks like we're still taking a risk-off stance where substantial portion that is usually in the cyclical stocks for the S&P 500, we're really underweight that. We have no basic materials, financial services, or real estate, although we do somewhat match the S&P 500's allocation to consumer cyclical. Our sensitive sectors are pretty much right in line with that of the S&P 500. Communication services are a little bit more. Technology has taken up a significant portion of our portfolio, but that's pretty much right in line with the S&P 500 as well. Our defensive sector is very overweight that of the S&P 500, and it boils down to consumer defensive, healthcare, and utilities, which each of those are about double of the allocation to the S&P 500. So we've really taken a lot of our weight from the cyclical side and moved it into the defensive side. And you can see that most of our portfolio is made up of technology, consumer defensive, and healthcare. Those are the top three sectors in our portfolio. And those three combined make up about 66% of our portfolio. And we see that the foreign stocks that were in our portfolio are in the developed part of Europe. Okay, let's take a look at a few of the stats. The expected PE ratio of our portfolio is about 14 times earnings, and that's right in line with the S&P 500. We are paying a little bit more than book value for our companies, about 12% more than the S&P 500. So we're paying about 3 times the net assets of these companies. But our return on assets is a little bit more than that of the S&P 500. Return on assets is 9% more higher, and return on equity should be about 30% higher. And it looks like our earnings per share growth rate over the next 5 years is about 10% less than the S&P 500, although our dividend yield is about 50% higher than that of the S&P 500 at 2.85%. And the average size of our companies are about the same as the S&P 500, about 98%. So our top 5 holdings are CVS, Kellogg, Dominion, Medtronic, and Sanofi. And you can see just in our top 5, most of them are healthcare companies. For instance, 11.5% to CVS, Medtronic gets about 6%, and Sanofi gets about 6%. So you see the majority of our portfolios in at least the top 5 holdings is in healthcare type companies.